Hello everyone, I am Margie Sumagang. In this video, we'll be discussing a case study about bank reconciliation and adjusting entries for Haslehof Incorporated covering the period ending November 30. To give you a quick background, Haslehof Incorporated keeps track of its cash transactions using its own books. However, at the end of each month, they need to compare their records with the bank statement to make sure everything matches, and if not, to figure out why. At the start of November, the company had a book balance of 2,510,871. During the month, they recorded 10,411,434 pesos and 60 centavos in receipts, and 9,893,612 pesos and 40 in disbursement. By November 30, the bank statement showed a different ending balance of 3,376,452. That difference, it needs to be explained and adjusted, and that's where bank reconciliation comes in. Now let's talk about the main issues. The main issue is to identify and resolve the differences between the company's book balance and the bank statement balance through bank reconciliation. These differences arise from outstanding checks that have been issued but not yet cleared by the bank, deposit in transit that have been recorded by the company but not yet reflected in the bank statement, bank charges and debit memos that have not yet been recorded in the company's books, credit memos such as bond interest collected by the bank that the company has not yet recognized, a customer's check return due to insufficient funds which requires an adjustment. Additionally, the company must record the appropriate journal entries based on the reconciliation to ensure accurate reporting of its cash balance as of November 30. This case emphasizes the importance of internal controls, timing differences, and accurate recording in the accounting process.
In this case, we are going to use the adjusted balance method where both the book balance and bank balance are brought to correct the cash balance. The unadjusted bank balance as of November 30 is already given, which is 3,376,452. In order to arrive at the book balance for November, we are going to use the book balance from the previous period, October 31, which is 2,510,871 pesos. Now we add to our balance the receipts, which is 10,411,434.6, and deduct the disbursements with the amount of 9,893,612.4. This leads us to the balance per book in the amount of 3,028,693.2 for the month of November. As for the book reconciling items, we add the credit memo of bond interest in the amount of 84,000 and deduct the debit memos, which are the bank and service charge amounting to 1,644 and NSF check amounting to 22,327.8, which gives us an adjusted book balance of 3,888,721.4. As for the bank reconciling items, the deposit in transit must increase the balance by 114,924 and deduct the accumulated outstanding checks in the total amount of 402,654.6, which gives us the correct cash balance of 3,088,721.4, which is the same as our adjusted book balance. To ensure accurate records, we are to make necessary adjusting entries to reflect the correct cash balance, debit cash in bank, and credit interest income in the amount of 84,000 to record the bond interest collected by bank, debit accounts receivable and credit cash in bank in the amount of 22,327.8 to record the NSF check returned by the bank, and lastly is debit bank service charge and credit cash in bank in the amount of 1,644 to record the bank service charges of the month.
So hello everyone, my name is Camilo Ticopecas, and for today we are going to talk about the key principles and relevant accounting standards that are very essential in doing bank reconciliation. So the first key principle is the accrual principle, where revenues and expenses must be recorded when they are earned or incurred, not necessarily when cash changes hands. In bank reconciliations, adjusting entries, for example, bank charges or interest income, help align book balances with the accrual principle. Next one is the matching principle. Expenses must be matched with the revenue they help generate in the same accounting period. So for instance, bank fees must be recorded in the period they relate in, even if the entry is made during reconciliation. The third one is the consistency principle. The method and timing of bank reconciliation should remain consistent across accounting periods. This ensures comparability and reliability in financial statements. Fourth one is the reliability and faithful representation. Bank reconciliation ensures that cash balances in the financial statements truly reflect the entity's actual financial position. Adjusting entries help eliminate any discrepancies due to timing or errors. And last but not the least, internal control principle, where regular bank reconciliations serve as a key internal control to detect errors, omissions, or fraud involving cash. And now for the relevant accounting standards. First one is the past one presentation of financial statements. It requires a faithful representation of financial position, including accurate reporting of cash. Bank reconciliations support the truthfulness of the cash balance shown on the balance sheet. It ensures that users of financial statements can rely on the reported cash figures. The second one is past 7, or the statement of cash flows. It governs the representation and classification of cash flows. Accurate bank reconciliation ensures that the cash and cash equivalent reported in the statement of cash flows are accurate and verifiable. Discrepancies due to timing differences, for example, deposits in transit or outstanding checks, are adjusted through reconciliation. reconciliations. Third one is PAS 8, which is accounting policies, changes in accounting estimates and errors. It requires that errors be corrected and disclosed properly. If bank reconciliation uncovers prior period errors, for example, unrecorded transactions, PAS 8 guides how to correct and disclose them. And for the last one, for relevant accounting principles, PFRS for SMEs or small and medium-sized entities. For non-public entities, simplified accounting principles apply. Section 7 of the PFRS for SMEs deals with cash and cash equivalents, emphasizing the importance of internal control procedures such as regular bank reconciliation. Of course, when it comes to making bank reconciliation, the key principles and the relevant accounting standards is not limited to those mentioned. These are just what we utilize to ensure that what we were doing with the Haslehof Incorporation's given data were presented truthfully and correctly.
So good day everyone, I'm Zarina Antoinette A. Cañete, and I will be presenting the recommendations that was drawn by my group for this case study. So for our first recommendations, we recommend a timely bank reconciliation. It is recommended that the company performs bank reconciliations at the end of each month. This regular process helps ensure that any discrepancies between the book and bank balances are identified and resolved promptly and in a much earlier stage. By reconciling monthly, the company can catch more errors, unrecorded transactions, and fraudulent activities in a much earlier time, thereby maintaining an accurate and reliable timely financial record. The next recommendation is a prompt recording of bank transactions. Items such as bank charges or NSF checks or credit memos like bond interests should be recorded as soon as they appear on the bank statement. Delayed recording of these items, as seen in this case, can result in an inaccurate cash balance and financial reports. To prevent this, the company should implement a routine review of bank statements or set up alerts to ensure timely updates in the accounting system. So we recommend that they implement a routine in which they check for items such as bank charges or NSF checks or credit memos so that they can update it to the balance as soon as it happens. So the next recommendation that we have drawn is monitoring deposits in transits. Deposit in transit must be closely monitored to ensure that they are deposited and reflected in the bank on time. In this scenario, a deposit of close to 115,000 pesos was still in transit at the end of the month. Regular monitoring and follow-ups are essential to ensure that such deposits are not forgotten or lost or fraudulently diverted, which could impact the company's liquidity and accuracy and reliability when it comes to its financial reports. The fourth recommendation that we have drawn is managing outstanding checks. In managing outstanding checks, these checks, such as those listed in the reconciliation, should be tracked carefully. The company should maintain a running list of issued but uncashed checks and follow up on those that remain unpresented for long periods, since dili magina to siya makaligyan that nagyo mga checks na outstanding or like uncashed pa but is issued. So the best thing the company should do is keep track of this checks, like for instance, make a list about it, and unclaimed checks should be voided and be reissued if necessary. This practice helps prevent overstated liabilities and supports a cleaner and more reliable and credible reconciliation process. The next recommendation that we have drawn is making proper journal entries for adjustments, because journal entries are an essential process that can help with the bank reconciliation process. All adjustments discovered during the bank reconciliation process must be recorded in the books through appropriate journal entries. For example, bank charges, bond interest, and NSF checks should be accounted for to ensure that the book balance accurately reflects the company's true cash position, even in their bank balances. Consistent recording practices will help maintain the integrity of the financial statements. So this is also in track of the company's integrity when it comes to keeping track of the adjustments that were made to reconcile the book and the bank. What we want to recommend next is to strengthen their internal records. To improve transparency and reduce the risk of errors and fraud made by a single personnel, the company should enhance internal controls by segregating duties related to cash handling to different employees rather than focus it to one. Different individuals should be responsible for issuing checks, depositing funds, and performing reconciliations. And through this structure, they could ensure better oversight and build a reliable audit trail for financial transactions. And our last recommendation is the company should have a regular cash flow review. With the accurate adjusted book balance determined from reconciliation, the company should conduct regular reviews of its cash flows. This will aid in identifying trends in cash usage and support better budgeting and liquidity management and decision making. A consistent review process will contribute more to a more informed and timely and more pasok sa trend na financial decision making, and an overall successful and healthy financial condition that is very beneficial for the company. And that was the recommendations that was drawn by my group from this case study. Thank you.
Good day everyone, I am Mabel Pidio and I will be discussing our conclusion. So our case actually highlights the importance of performing regular and accurate bank reconciliation to ensure the reliability of financial records. We reviewed our bank reconciling items such as our outstanding checks and deposit in transit. We also reviewed our book reconciling items such as our credit and debit memos where we have our bank charges and NSF checks. And we successfully matched our adjusted book balance and adjusted bank balance to 3,088,721.40 pesos. The bank reconciling process not only ensures the compliance of the accounting standards and accounting principles, but it also improves the accuracy of the company's cash position. The key insight here is timely reconciliation and proper recording of transactions is actually essential to make sound judgments in terms of our financial management and decision making. And that concludes our case study.